The world is fractured. Divisive politics and national interests are playing out on the fields of the global economy. Growth rates are recovering. The bull market continues to run and asset bubbles are forming. But sustainable and inclusive economic development seems hard to come by.
In this episode of the Davos Guide, we look at fractured economics and analyse how stakeholders, from governments to policymakers to the business community, can keep the recovery in the world economies alive and stave off any shocks that could come from monetary policy tightening.
2018 marks a decade since the collapse of Lehman Brothers, an earthquake that shook financial markets and developed economies to the core. 10 years on, major equity markets stand at record highs as investors find reason to cheer the policies and frameworks that have freed up markets shackled by post-crisis regulations. All of this, of course, underpinned by ultra-loose monetary policy.
But central banks now find themselves undertaking the great unwind, reversing a decade of money printing and easy policy. Could have spooked investors. But as the world's policymakers started to reel back the extraordinary measures, the taper tantrum that everyone feared never materialised.
Speaking to CNBC last year, bank chiefs welcomed the beginning of the end of the low-rate era.
Among the positive signs that I've seen in the last 3 months and beginning of this year, one thing is probably that effectively the central bank has more margin of maneuver if the rates are increasing in the US, if the Fed is normalizing. It gives more opportunity going forward beyond probably end of 2017 for the ECB, provided growth is there, maybe inflation outlook is better, to carry on normalizing progressively and of course exiting this negative rate environment, which is difficult to manage for the financial sector.
I think if the collateral damage of low rates or negative rates would only affect banks, it would be okay, but it's starting to affect savings, most the pension fund systems, insurance company, and the confidence of people who have been saving money, thinking that they can live a little bit out of their income to continue to prosper. And that is creating also this sense of inequality that goes on in Europe.
You want rates to rise for the right reason. There's good demand, and wages are rising in America, the economy is growing in America. That's the right reason. If you had it because of a wrong reason, inflation got out of control and things like that, that would be very concerning. But right now, I think we're a long way away from that.
I'm delighted to welcome to this show John Straczynski, who is Vice Chairman of Blackstone, Lord Mark Malloch-Brown, who is a former UN Deputy Secretary General, and Manoush Shafiq, who is former Deputy Governor of Markets and Banking at the Bank of England. Manoush, thank you very much indeed for joining us. The other two are veterans of our show, so let's start off with you here. The central banks looked like they did a pretty good job in 2017. They held the hand of the markets. They timed their exit strategies, it seems, pretty well. Investors seem soothed. Economies seem like they're gently moving in the right direction. But the dangers of policy missteps going forward, do you fear that they are quite out there still, or actually you feel that central banks will just carry on with the same policy and we're going to be okay?
Well, I think central banks have done a very good job so far in signposting where we think interest rates are likely to head. I think they've also signaled that there are structural reasons why we are in a low for long world for quite a while. So we don't expect rates to go back to the kind of 5% levels that we saw historically. But on the other hand, everyone would like to get up off the floor of low interest rates so that if we face shocks in the future, central banks have somewhere to go.
Let me pursue a little bit longer. We had a strategist on our show, Squawk Box Europe, a few days ago in early December, saying the hand-holding, the forward guidance that the central banks have given the markets, whilst it's been useful at various stages of the crisis, it's now actually the greatest problem as well. And actually they need to take away the nannying of the markets, the guidance from the markets, and actually let markets be markets and economies be economies without this hand-holding. Do you have some sympathy with that view?
You know, I think forward guidance takes many forms. It appears in the forecasts that central banks issue. It appears in the words that central bankers use when they describe their strategy for normalization. And so I think there's always an element of forward guidance in what central banks do. It's just a question of the form that is appropriate for the moment.
One of the, John, one of the themes, I think, since 2008 and the great financial crisis has been this idea that trickle-down economics can work if you throw enough money at it, and by allowing asset prices to rise, there's been this view that ultimately that would be benevolent and good for the broader community. And yet here, as we look at where we are in markets, and yet the difference we see in terms of compensation for those who've done very well in this phase and those who haven't, do you think that we're starting to raise difficult questions about the idea of trickle-down economics, that actually we need other policies to run alongside this central bank-led economic recovery that actually help those who've not benefited from this reflationary trade?
Jeff, I think it's good that the central banks are stepping back. I think we've had an unprecedented expansion, really driven by the guidance and the very positive support from the central banks. Having said that, we do need to come to grips with the role of both the positive as well, positive in terms of potentially enhanced productivity, as well as disruption from elements like technology in terms of wealth distribution. And I think there are so many bigger factors in the world right now, such as technology, that is going to cause an even greater dispersion of the gap between the rich and the poor, or dispersion of wealth, that those types of things in terms of investment and training and re-education, all of those issues are going to have to be dealt with more proactively. And not to make them a poster child, but the Chinese, of course, are planning, they have a planning-oriented economy, and they are very focused on the role of technology and growth and how they bring their economy along using technology and using investment. And I think China is a good example in this environment of where a centrally planned economy is actually has an advantage, perhaps, over other economies that are still much more laissez-faire, or much more, how to say, based on pure sort of entrepreneurial economics.
And yet, through this cycle, whilst we've seen a recovery in markets and we've seen asset prices rise, there have been some puzzling and troubling issues that remain unresolved. Like, why do we have very low inflation and disinflation still in some markets? John referenced technology. That may be partly a factor. We're not quite sure. And the other area, of course, where we, I think, still are struggling to understand what's going on is the level of debt that has risen, not only on central bank balance sheets, but among Western consumers and among companies. Have we effectively just brought forward consumption over the next 10 to 15 years? And are we going to see much, much slower growth rates emanating from 2018 onwards?
Well, Jeff, I think in many ways our politics and economics is a struggle with an underlying fact that we all have difficulty getting our heads around, which is the shift of wealth from west to east in the global economy, the rise of a massive new Asian middle class, and at either ends of the spectrum also the rise of, you know, a small 1% class of very wealthy, disproportionately represented at Davos, and at the other end of the scale a Western middle class and blue collar class which has not gained, and where the financial crisis worsened their situation. And so yes, I think politics and economics has been about offering palliatives to that latter group at the expense of tackling the real issues of productivity and technology transformation in our economies, and also at the expense of not, in a sense, confronting the fact that the new growth opportunities are indeed going to be in regions like Asia, and we'd do ourselves a favor by migrating a lot of capital and a lot of human energy to making a success of Asia's economic revolution.
We'll leave that conversation there for the moment, but of course another phenomenon which took over in, certainly a fever in 2017, taking the world by storm, was cryptocurrencies, luring in investors from all walks of life with the promise of outlandish returns. Opinion, as you know, is deeply divided, with the JP Morgan CEO Jamie Dimon famously calling Bitcoin a fraud. Janet Yellen used her last speech as Fed chair to describe virtual currencies as highly speculative. But a number of influential investors have told CNBC they believe the sky's the limit for the likes of Bitcoin and the technology supporting these products, that, like blockchain, for instance, which are widely seen as revolutionary. Blockchain is something that all the banks, John, seem to be very excited about, but equally so, Bitcoin is something they have a great deal of trepidation about. Central banks feel it is out of their control as well. Do you see the great opportunities from the technology behind blockchain and devices such as Bitcoin, or do you fear it's going to lead to what many call another set of tulip-like bubbles?
Steve, I think I'm personally, in terms of the cryptocurrency fever that we're experiencing right now, I think I'm more in the skeptical fad, short-term element camp. I do think if you look at the fact that China, of course, is increasingly the most important, apart from America, economy in the world, the Chinese are not prepared to accept Bitcoin, for example. They've banned it. They have very clear views about how the banking system, all done through the smartphone, really led by Alibaba and several other people, are going to continue to dominate the consumer. And they want to bring that broader behavior to other markets. And I think Jeff Bezos and Amazon feel very much the same way. So I think you're going to have some other dominant players in the world that are going to undermine, if you will, the success of things like, or the potential success of things like Bitcoin and blockchain.
I mean, is that the correct prism to see this through, that cryptocurrencies are an also-ran in terms of fintech evolution, and sometimes that just happens. You get these fads and phases, but ultimately, as John seems to be suggesting here, it'll fall to the wayside, and things like Alipay that have a more solid technical foundation will come to the fore.
I mean, I slightly hesitate whether anybody over 30 dares answer this question, to be honest. But, you know, answering it from a political point of view, I think part of the sort of tulip component of this is that, you know, Silicon Valley is a very libertarian place in its politics. And the idea of an invention, a cryptocurrency, which sweeps away the great establishment of central banks and the rest, you know, has a romantic attraction to the kind of people in Silicon Valley. But I think the second, more recent lesson of technology is, you know, it's not always the first ones out of the gate. It's not the first movers who necessarily prevail. And so I'm sure some element of cryptocurrencies and blockchain and everything else will be transformational in how technology is applied to our societies going forward. But I kind of think it'll be a next generation which saves some of this, but then goes in some different new directions as well.
The problem is, you, I, John, Jeff, over 30, could afford perhaps to not be able to answer it. Most central bankers, Manoush, are over 30 as well, but as well as their role, which you just mentioned about trying to create the right level of inflation, they also have a supervisory role, of course, stability board role as well in many cases as well. A lot of over 30 central bankers have got to get up to speed on this one very, very quickly. Do you feel they're up to the job at the moment? Is it going to just bypass the knowledge base of current central bankers?
Well, actually, you know, when I was at the Bank of England, we spent quite a lot of time trying to understand what was happening in this area. And I think it's important to state this is not a currency. People are not buying Bitcoin to do transactions, which is what a currency is for. This is a speculative asset, and people are speculating on it. And like all speculative assets, they go up and then they go down. And having said that, I think there's some very interesting things in the technology of distributed ledger technology, which will have very interesting applications, as Mark indicated, in far less sexy areas like documents keeping, record keeping, back office functions in banks, which will be very useful to the financial system. But that's a very different thing than a currency.
Can I say, I've known Manoush for 30 years, and she's still under 30. She's the only one who should be allowed to answer this question.
You're very kind, Mark. Very
old
kind.
fox. Let's move on very quickly. Everybody's going to stay with us. Coming up after the break, We're going to be focusing a little bit more on the capital market stories, and of course we're going to spend a little bit of time talking about where bubbles may re-emerge. Will it be in the M&A space or the IPO space? Stay tuned.
Welcome back to the Davos Guide. Fractured economics.
While the world of macroeconomics has entered the tightening cycle, companies across the globe have continued to use the cheap money to make deals. Dividends have also made a comeback. At the start of 2017, industrial, telecom and basic resources stocks dominated the M&A landscape. But as the year progressed, retail and media began to take center stage. Amazon stunned investors and consumers alike with a whopping $13.7 billion buyout of Whole Foods, rattling the e-commerce as well as the bricks and mortar retail sector. The dominance of Jeff Bezos' firm has been cited as rationale for a number of defensive M&A moves, from pharmaceuticals to media. And so another deal was born in the shape of Disney, taking on over $50 billion worth of 21st Century Fox's assets. The tie-up provides Disney with additional infrastructure as well as fresh content, while 21st Century Fox gets to refocus on its legacy media businesses.
2017 also saw some high-profile deals fall through, though, as CEOs told us they were cautiously optimistic for the year ahead.
The M&A report globally is more positive than negative. We think there'll be a pickup in 2017 in the second half, and then much better in 2018. But we've already seen a drop-off in IPOs, particularly in the UK. We think that will come back a little bit, but overall, we're predicting that there will be a downside effect in the UK and M&A activity.
Logic stands in full force. We have done both the London Stock Exchange Group as well as Deutsche Börse Group, as well as many other exchange companies, are used to doing cross-border business. It is indeed in the nature of global capital markets to do so. And I believe political participants, political actors understand that very well. And I think they can benefit from having an institutional design that crosses borders in times of uncertainty.
At Novartis, we have a clear strategy around innovation. R&D is the core of the company. We're going to continue to invest. We're going to watch how developments occur in the U.S. with the new administration, and then we're going to act accordingly based on those actions. And so we're looking forward to a more robust U.S. economy.
And if 2017 was the year of M&A, will 2018 be the year of the IPO? There is one particular IPO that is capturing the world's attention. Described as a once-in-a-lifetime event, Saudi Aramco will list part of its estimated $2 trillion portfolio on its local exchange, as well as one other international stock market. The debut forms a key part of the Crown Prince's 2030 strategy for reforming the kingdom's economy, and it will also provide the investment banks who get in on the action with a huge windfall. So let's bring this conversation to our panel. John, let's start with you, because I think you're probably closer to this segment than our other two guests. Do you think that we will see the same strength in M&A and IPO in 2018 that we've seen in 2017, with interest rates starting to edge a little bit higher?
I think interest rates edging a little higher isn't really going to be the issue. I think, as you've always heard me say, Jeff, M&A is driven, you have to look at it sector by sector. Secondly, I think in this case, if you look at the two major deals that we've hallmarked so far in 2017, namely the Fox Disney deal, as well as the Amazon Whole Foods deal, they're also driven by the need for scale in the sort of technological disintermediation landscape. That's a mouthful, I'm sorry. But the reality is both of those deals are first mover advantage. Both of those deals, it's classic Rupert Murdoch. first mover advantage. I think there's going to be seen as a greater need because of technology, because of content, because of capital structure needs and cash flow and balance sheets to create larger and larger media players who have more flexibility. And I think we know Jeff Bezos well enough to know that the market capitalization of Whole Foods and what he paid was actually less than what happened to the stock price of Amazon on the day of announcement. Namely, it's not only a project, but I think it will be successful because Jeff Bezos knows that 50% of the retail space in the United States and globally, of course, is food. And I think technology is going to be a driver of M&A, both on an offensive as well as a defensive level in 2018.
Manoush, Mark, Amazon is a rare example of a company that the market allows to not make money. It says you're growing scale in all these kind of markets, new markets, as John's been mentioning, in food. The pharmaceutical industry is terrified by it as well. It is allowed not to make profit. Other companies, from retailers to consumer products companies, have to make profit for their shareholders, but are finding themselves squeezed more and more as they try to compete with the technological threat that comes in the form of Amazon and others as well. Are we in danger of going into a world now where profits are much harder to come by, margins are going to be a lot less, and that's going to have big ramifications for the economy and indeed underlying society? Mark, what do you want to kick off on that?
Well, look, I think there is, in that sense, it's right that if you have a really compelling narrative about how one day you're going to make profits, the markets are benevolent about letting you defer that moment for a while to come. But I think it's a narrative that only works in certain sectors and certain situations, and I think Jeff Bezos is the master of it. But, you know, he's building a business which is going to be enormously profitable, is the bet that everybody's made. It's just not yet today kind of thing. But I think if you look at the Saudi Aramco deal, if I may, I mean, I think that's something else entirely. That was the signal of a kind of modernizing and a greater transparency into the Saudi economy. The potential effects have now been offset by the extraordinary sort of lockup in the Ritz-Carlton of the business leadership of the country, which, you know, seems to be at cross purposes with the earlier message that we're going to move into a more, you know, market rule-based Western economy. So I think what these different deals show is, John's right, it has to be sector by sector, but in their very different ways, Saudi Aramco and Whole Foods do show that there are reasons still for doing big deals which aren't just P&L.
And yet, Manoush, do you feel, and again, you're not an M&A expert, I'm not going there with you, but what you are an expert is on the societal impact of what happens from corporates to the broader economy. And rather than concentrating on your employees' productivity, your employees' education, rather than spending on CapEx, on plant, then these big companies are doing bigger and bigger deals to confront various threats, whether they're defensive or they're going on the front foot as well. Is that a danger, and is that something you feel quite strongly about?
Well, I think there are a lot of economists concerned about the fact that corporate profits have actually done pretty well, and they're sitting on very large cash piles, and they're restructuring their balance sheets and, you know, deleveraging and paying dividends and doing everything but investing in productivity. And for the long term, that's a big problem.
John, let's come back to you here. So just as we look at 2018 in the round, is it going to be a good year for private equity, a good year for investment banks, a better year perhaps for markets?
You've just talked about 3 different courses at the Harvard Business School, Jeff, and you want me to answer that in a very succinct way. I will say we're operating in a very, very challenging investment environment right now, and I think the investment environment will continue to favor people who will have to pay very competitive prices for assets, but be particularly astute and clever at what, at least at Blackstone, we call the fix element. There's the buy, there's the fix, and then there's either the sell or the hold. And it really is, in this environment, going to put a lot of onus on managers, asset managers, operations, and people who can really reposition assets to deal with this increasingly global and technologically sort of rigorous environment. I think the capital markets obviously The debt markets remain calm with not as much volatility as people would like in terms of making money. And, you know, we all know that interest rates are at a 50 to 60% low, below a sort of 25-year average in the United States, the UK, and Australia. And I think the bigger issue, and probably best served by another member on this panel, is not whether interest rates are going to go up. They are going to go up. It's a question of how quickly they go up and how that changes the perception of volatility, and that will change the amount of financing that investment bankers take part in the market.
Terrific answer, John. Thank you so much for that. John Stadzinski, then, Vice Chairman of Blackstone. Lord Mark Malloch Brown, the former UN Deputy Secretary General, and Manoush Shafiq, former Deputy Governor of Markets and Banking at the Bank of England. Thank you so much for being on our programme. And to follow us on social media, search CNBC International across all major platforms, including Facebook, Twitter, YouTube and Instagram. And you should stay tuned to CNBC to catch our Davos Guide special programming broadcasting throughout the holiday season.
Yes, that's what Christmas is for, isn't it? And of course, join us in January when we head to the World Economic Forum 2018. We've got 5 days this time, Jeff. Yeah. 5 days of live coverage from that event starting on Monday, 22nd of January.
So thank you, everybody, for watching this edition of the Davos Guide. We'll see you in the Alps.